does that dovetail then, Nathan, into this idea of some spike in unemployment and this sort of hard landing type of narrative that has been all but taken off the table?
Right. So on the one hand, we've had the labor hoarding, in my view, in the manufacturing sector. Maybe some of that's starting to give. But I think that we need to see some easing in services spending, a rise in the overall savings rate. I think we will see that, but it's more likely to be an early 2024 story. And there's more uncertainty around it. I mean, many of our competitors are shifting their macro calls away from recession in early 2024 to soft landing. You know, based on history and the tightness of the labor market and some of the imbalances in the economy, we're not there. We still think that there will be a recession next year, but boy, this is a very, very finely balanced call between soft landing and recession.
Where have you got rate cuts?
We've got them in Q2.
So there we go.
So
we're arguing over 6 months here?
Broadly, I'd say broadly speaking. Now, where it gets a little trickier is if we're wrong and there isn't a recession and we're looking at a soft landing. I think a feature of a soft landing scenario that is not getting enough attention is it means that rates are going to be higher for longer. That recession is going to open the door, if and when it occurs, to more aggressive Fed rate cuts. If we don't get it, it's going to be a gradual glide down in the Fed funds rate in coming years.
When you say that rate cuts are going to happen, does that happen well before inflation rates are south of 3%?
I think that in engaging inflation, it's really important to be looking at those monthly prints and thinking about them. And I think that it will happen in our forecast kind of in the second part of a two-quarter recession. And by that point, the Fed will be fairly confident that inflation is moving down sustainably into the 2.5% range.